I've noticed a trend over the last couple of earnings seasons where companies that end up doing well on their earnings reports, think of Tesla for example, end up trading flat after good earnings, whereas stocks that don't do well on the earnings report, think of Netflix or think of Facebook last quarter, end up getting absolutely crushed. So this is how I'm playing this earnings season. Now, usually whenever you think that a company is going to do well on their earnings report, you'll buy a call option in anticipation of the stock going up after good earnings, and that's logical. Good earnings should translate into stock going up. But right now, we're not seeing that because of the macroeconomic uncertainty. We have inflation at 8.5%, we have interest rates rising at some of the fastest paces that we've ever seen, and then there's also global issues like Russia, Ukraine, and also China with their lockdowns because of COVID. So all of this is just adding to the uncertainty in the stock market, and companies that do well in the earnings report are just trading flat instead of going up like they normally would. And then companies that are on a decline, think of Netflix and think of Facebook and their active users going down over the last couple of quarters, their stocks are getting absolutely punished. So if you think that a company is going to see a slowdown in their number of users or their revenue or their earnings, then it might actually be worth shorting the company or buying a put option. But the problem with buying a put option right now is that this volatility is already baked into the options market. So this means that you're going to pay more for a put option than you probably should be. And then if the company doesn't do as bad on their earnings as you were expecting, then you're going to end up losing money buying that put option. So this is how I would play this earnings season. I already tried this strategy out on Snapchat last week by opening an iron condor. If we look at my history here, I opened this for $175 and I was able to close it for $20, taking $155 of profit, even though Snapchat didn't do a lot after the earnings. They went up to $30.30 at the close before earnings, and right now they're trading at $29.90. So the stock has moved a whopping 40 cents. But that's in the past. So let's look towards this week with the companies that are reporting earnings. If you go to eWhisper's Twitter, we have Facebook, Apple, Microsoft, Amazon, PayPal, Google. The list goes on. So for the companies that you think are going to do well, like I thought that Snapchat would last week, you're going to assume that they're going to trade flat. So a good example might be Apple. They tend to have good earnings reports. So let's go to AAPL, go to their option chain, set our expiration date for this Friday, so right after the earnings report. Now I'm going to assume that Apple will probably trade between $150 and $170 after the earnings report. So assuming that it's going to stay above 150, we're going to sell a 150 put. We're going to buy a 145 put against that, and we're going to get $69 of credit just for that. And then we're going to assume that it'll stay below 170, selling a 170 call, and then buying a 175 call. And in total, we're going to get paid $130 in credit in order to open this. Since the difference between our strike prices is $5 between the puts and then $5 between the two call options, we're putting up $500 of collateral, which means that we can potentially lose up to $370 if we're wrong about this trade. But this means that Apple needs to go below $145 or lose more than 10% this week, or it needs to go up by 10% this week to $175, which I think is highly unlikely in this market environment. If their company does well in their earnings report, the trend has shown that their stock is bound to trade flat. But if I want to pick a company that I think will do poorly on their earnings report, maybe we can use Spotify as a good example, just because I think that this market is already saturated. I think that most of the people that are going to download Spotify already have downloaded Spotify. So I think that their user growth is going to decline or be mostly flat. We'll go to Spotify, trade their options, and then set the same expiration. Now, if you think that a company is going to do poorly on their earnings report, you would think to buy a put option. But the problem with buying a put option right now, if we were to buy, say, this $110 put, assuming that Spotify will be below 110 on our expiration date, April 29th, we're paying $705 to open this. So in order for us to make any profit by the end of the week, Spotify needs to be $7.05 below our $110 strike price, or basically below 103 in order for us to make any profit on this trade. Another problem with opening this Right now, implied volatility for this option is 177.5%, which is extremely high. I think after the earnings report, this would probably drop by 100% down to 75 or 80%. And if that were to happen, this option is going to lose its Vega value, 0.0463, times the 100% drop in implied volatility. So if Spotify were to trade flat after the earnings report, this option would only be worth $242. So that's almost a $500 loss if Spotify ends up trading flat after earnings. So a better way that you can go about trading this earnings report, if you think that Spotify is going to have a bad earnings report like I'm assuming, is doing a call credit spread instead. So I'm going to try to find a call option that has around a 0.3 delta value, which means that there's only about a 30% chance of the option expiring in the money. So a 70% chance that the trade is going to go in our favor. And if we go with this 125 call, it has a 0.298 delta value, so that's pretty close for us. We're going to sell that call option in order to open it, and then we're going to buy a call option above it. So if we buy the 130 call, we're going to get paid $100 in credit for $500 in collateral. So that means we can lose up to $400 if we're wrong about this trade. But as long as Spotify stays below our $125 call strike price, we get to make that $100 in profit. Now, of course, I could be totally wrong. Maybe Spotify has a really great earnings report. Maybe their user growth continues, but it doesn't seem very likely to me in such a saturated market. So we'll have to see if my predictions are correct this week. But overall, I think that companies that do well on the earnings report are going to trade flat, and then companies that do poorly on their earnings report are going to get crushed. So that's how I'm trading earnings this week. Hopefully you found this video useful. Thanks for making it all the way to the end, and thank you to all my patrons for their support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.